Hi everybody, Brian here from quantlabs.net. Today, over the last few days, I talked to somebody who's a pretty big wig money manager back in his days. Just thought I'd give you some insight of this new regulation that's coming out of Europe called MIFID II. Basically, market in financial directive, and this is an article on from tradersmagazine.com. Articles called MIFID II, another well-intentioned regulation that could undermine investment boutique managers. So this kicks in, I believe, January 3rd, 2018. And it's amended law which goes into effect, stems from regulations of the European lawmakers, which obviously is usually not that good, enacted to regulate how asset managers pay for the research they utilize in making investment decisions. Good intentions and primary benefits creates more transparency for clients and transfer the cost of research from clients in the form of trade commissions to the manager if the manager doesn't pass this cost back to the client. So just reading out of this article, it says significantly amount of large brokerage houses and asset managers seem to be adopting regulations on a global scale, which we believe will transform expectations on how investment managers should allocate and report their expenses incurred for security research. The purpose of this research note is to evaluate the impact of these changes on boutique and smaller entrepreneurial investment managers. So, I'm not going to go into too much detail. You can easily read this article in full regalia on my blog. And here's some of the research companies are charging. Financial recently published an article stating that credit agricole costs starting at €60,000, Nomura $134 for premium, Deutsche Bank $35 for 10 people, Bank of America ML premium package priced at $100K, and JP Morgan and Goldman Sachs are still yet to be determined. So there's going to be a lot of it's going to hit a lot of these smaller firms a lot harder, which enables the larger players to squeeze out the smaller players on the research front. This change, as noted, could also tip the scales towards quantitative strategies that are less dependent on third-party fundamental research. So in the world, that's affecting us. So there's a bunch of other impacts as well. Here on the third page. Anyways, with the discussion I had, and now I've cleared out a lot of the specifics of some of the impact. But if you were to start a hedge fund equivalent, the up potential is usually 2% of, let's say, 30 million pockets you 600K, but you also need to factor in your fixed costs of office, staffing, accountants, lawyers, auditors, and custodian. Also, if you were to do this out of China, a lot of problems in China is where there's a firewall, humidity, fake software hardware, corrupt cables, landlord access to server. So these are some of the problems that you will face if you were to go into a place like China. You also have to guarantee your investment vehicle, where investors are used to having downward protection, and that basically means you're guaranteeing no loss. And because of this MIFID II regulation, it makes it companies or investors to sue. So there's very little impact if you're 100 billion plus fund or trading off a large trading desk for a major oil corporation, let's say. You could also expect to be paying out an annual fees of about $1 million with the legal costs and the regulatory. So there's that. Also, if you're willing to take on small investors of less than $1 million, essentially it's not worth it, because now with this new regulation they can sue a lot easier for losses, and some will get together for potential class action, and it will happen more frequent. So at the end of the day, with this MIFID II, it does make not worth it to manage other people's money. I just think it's easier just to build up your own little fund and keep it that way. I just wanted to let you know what I think, and that's my intention, because this liability is just not worth taking on with this new regulation coming out of Europe. So hopefully I'll help you out. Talk to you later.